Good afternoon and welcome to the SC Launch and Learn with Sterling Moose with Haynsworth, Sinkler, and Boyd. Today we are talking about the re-emergence of the C-Corp. Before we begin, I'd like to go over two housekeeping items. First of all, my most favorite housekeeping item, if you can hear me, please raise your hand in the webinar controls. Paul, great, thank you. Anyone else? Are Paul and I out on an island? Can anybody else hear us? Okay, great. Thank you, Matt. Thank you. All right, y'all can go ahead and lower your hands. Secondly, on the format of today's webinar, we will keep the audio muted for all of our participants. So if you have any questions, please feel free to type them into the webinar controls at any time. We will pause about halfway through for a Q&A, and then again, we'll have a Q&A period at the end. I will be reading the questions out loud, and Sterling will be answering them. Sterling is an associate with HSB in their Columbia office and focuses her law practice on corporate and nonprofit tax law. My name is Julia Linton, and I serve as the operations manager for the SC Launch program. Thank you for joining us, and I'd like to say welcome to Sterling, and the floor is now yours.
Thanks, Julia. All right, so everyone, thanks for joining us. Hope y'all are having a great day so far. Today we're going to discuss some really interesting stuff. We're going to discuss some entity taxes and compare how different entity structures are taxed. And then we're going to discuss some of the changes from the Tax Cuts and Jobs Act and how those changes may impact a decision when choosing between entity structures. So to get started, we're going to walk through different entity structures that are available for a business, for partnerships, C corporations, and S corporations, and each structure is broken down into 3 stages: the formation, operation, and exit. So first, we're going to go through a partnership. We're going to have these little images. We have a partner A here, and then AB partnership. So we'll go through what's going on there in a second. So section 321 of the Internal Revenue Code allows partners to contribute property to a partnership without having to recognize a gain or loss. This is called a non-recognition event. The partnership holds the property with the same basis the partner had in the property right before contributing it, and the partner holds the new partnership interest with the same basis the partner had in the property right before contributing it to the partnership. And there are no restrictions on who can be a partner. So in this example, we have our partner is contributing a sewing machine to the partnership, and then the partnership is transferring in back to the partner a 50% interest in that partnership. So our individual, we're going to assume he paid $500 for the sewing machine. He is going to hold the 50% partnership interest with a basis of that $500, and the partnership is going to hold that sewing machine with a basis of $500 as well. So then into operation, partnerships are considered pass-through entities and are taxed at the partner level rather than at the partnership entity level. Assuming the partnership has income for the year, each partner is liable for reporting a portion of that income on their personal income tax return, regardless of whether a distribution is made to the partner. Partners also may be liable for self-employment tax on some amounts, in which case an additional tax is going to be applied to each partner's distributive share. And partners may be able to personally deduct losses of the partnership to the extent of their basis in the partnership, which is of course subject to some limitations. Generally, there are no additional taxes that are owed by a partner as a result of the receipt of a distribution. But if the amount or value of the distribution is greater than their basis, the distribution is subject to tax. And we're going to have an example of this situation in the next few slides. Under Section 731B, partnerships don't have to recognize gain or loss on money or property that's distributed to a partner. So a partnership could make a distribution to a partner with no additional tax consequences to either party. And this is on the next slide. So here, this is an example for a partnership that is engaged in a specified service, trade, or business, which a specified service, trade, or business is defined to be engaging in services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any other trade or business where principal asset of the trade or business is the reputation or skill of one or more of its employees, which is basically a service provider. And here we have material participation by the owners, so they're not passive investors. So if AB partnership has $100,000 worth of taxable income for the year, A and B are each 50% partners, so they're each attributed 50% of the income for the year. So each is taxed $50,000 of income, regardless of whether they receive a distribution. The income attributed to each partner for tax purposes does increase that partner's capital account for the partnership, though. So assuming A and B are each in the highest tax bracket, which is 37% for individuals, they're going to each owe $18,500 on AB partnership's income. But then at the bottom of the slide, it shows how their capital accounts are changed. So A contributed that sewing machine for $500 and then is allocated an additional $50,000 to their capital account based on the attributed income of the partnership for tax purposes. So A's ending capital account is $50,500. B didn't contribute anything to the partnership, so they start with a zero capital account, but then they're allocated $50,000 of profit, like A, and their ending capital account is that $50,000. For ease of calculation purposes here, I did not apply self-employment tax in this example, but it may also apply, especially where there's material participation by the owners. And I didn't apply net investment income tax since the partners materially participate in the business and they're not passive investors. So this calculation, we're switching it up a little bit. The partners are still materially participating in the business, but we are not in one of those specified service trade or businesses. So here, the partners actually get the benefit of a QBI deduction, which is a qualified business income deduction, which is available for taxpayers who are not corporate taxpayers. So individuals, pass-through entities like partnerships or S corporations, trusts, etc., are allowed to take this deduction. It's equal to 20% of the non-corporate taxpayers' qualified business income, which effectively reduces the individual at the top marginal rate tax rate from the 37% in the previous slide to 29.6% on their taxable qualified business income. Again, the rate reduction is only available for taxpayers who are not engaged in one of those specified service trade or businesses. So if the reputation or skill of one or more employees is the reason for the revenue, including the business involved in investing will qualify as a specified service trade or business and therefore can qualify to use this lower rate. So here we have the $100,000 worth of taxable income that is attributed $50,000 to each A and B. So if A and B are in the highest tax bracket, applying that 29.6% rate after the QBI deduction, they each owe $14,800 on the partnership's income, as opposed to in the previous slide where we saw the $18,500 tax for AB's partnership income. So again, in this example, we're not in one of those specified service trade or businesses with qualified income so that we can have the QBI deduction, but here we have passive owners. So the 3.8% net investment income tax on distributions will apply. There's no change to the income tax that they have to pay for the partnership, but if they receive a distribution, then that 3.8% investment income tax is going to apply to that distribution. So then this slide is showing the tax effect of a distribution to the partner. So A, we're carrying over that capital account of the $50,500, reflecting the attributed income to A and A's contribution to the partnership. And then they receive a $25,000 distribution from the partnership, which reduces the capital account after their distribution. Here, the distribution is not subject to tax since the distribution is not greater than A's capital account, but we do decrease A's capital account by the value of the distribution. And then B, we're changing B's capital account from the prior example to show how the distribution is taxed to the partner if their capital account isn't larger than the amount of the distribution. So assuming B has a capital account of $20,000 and receives a $25,000 distribution, that takes out their whole capital account, so they have a zero capital account after the distribution, and $5,000 of that distribution is subject to tax because the distribution exceeded the partner's capital account. So assuming that they qualify for capital gains rates, which have a maximum of 20% rate that applies, B owes $1,000 in taxes for the distribution. So also, again, since owners are materially participating in the business, the net investment income tax is not applied to the distribution, but if they were passive investors, that tax also may apply. Upon liquidation, when partners decide to liquidate and end the partnership, the partners only have to recognize income if and to the extent the value of their portion of the distribution in liquidation exceeds their basis in the partnership. If there are no assets other than money that are distributed, loss must be recognized by the partner or partners to the extent their adjusted basis in the partnership exceeds the value of money they're distributed, plus their basis in any unrealized receivables and inventory. And Section 741 of the Internal Revenue Code states that gain or loss recognized is treated as a gain or loss from the sale or exchange of a capital asset, except the portion that relates to unrealized receivables and inventory items, and that amount is treated as taxed as ordinary and is taxed at a higher rate. So here we have AB partnership, and for purposes of easy calculations, we're assuming that the partnership's only assets are $75,000 of cash and the $500 sewing machine that was contributed by A. We're also not taking into account depreciation, just to make this simple. So we're splitting each of the assets between A and B. A gets their machine back for $500, and then the cash is divided between the two. So after we added the income that was attributed to A for tax purposes and deducted the value of A's distribution, we get a capital account at the $25,500. So then we have a distribution of this $37,750, and A's capital account is, of course, reduced to zero, and there is still $12,250 of the distribution left. So that is going to be subject to tax as a gain from the sale or exchange of a capital asset. And assuming we're in the top tax bracket, they would owe $2,450 in taxes on that distribution. So again, we're changing B's capital account to show how the distribution and liquidation is taxed to the partner if the capital account is greater than the amount of the distribution. So here, B is starting with a $40,000 capital account, then receives a distribution of $30,750, which leaves a capital account of $2,250 after the distribution. But since this is a distribution in liquidation, B is going to have that $2,250 as a loss and could possibly use that loss to offset other capital gains that they may have. So getting into C corporations, we are in the Internal Revenue Code provides a non-recognition rule for individuals who transfer property to a corporation solely in exchange for stock, as long as that person or persons is in control of the corporation immediately after the transfer. And control for this purpose requires ownership of shares that represent at least 80% of the voting power of the corporation and 80% of the total number of non-voting shares of the corporation. The corporation is going to hold the contributed property with the same basis as the individual who transferred the property to the corporation. The contribution rules are a lot like the partnership, but once we get into operations, C corporations change a lot from the partnership rules. But there's also not any restrictions on who can hold an interest in a corporation. So here we have A contributing to the corporation the machine again in exchange for 50% of the stock, and B is going to contribute $500 cash to the corporation in exchange for the other 50% of the stock. A and B are in control of the corporation immediately after the transfer, so A, B, and the corporation don't have to recognize gain or loss on the transfer. So again, assuming that A purchased the machine for $500 and B contributed $500 in cash, A's basis in the corporation is that $500, B's basis in the corporation is also $500, and AB's basis in the machine is $500, while AB also holds $500 worth of cash. So a corporation differs from a partnership in that the corporation itself pays tax and is not a pass-through entity. Shareholders only have to pay tax if and when they receive distributions from the corporation. So although income that is not distributed is not taxable to the shareholders, that corporate income that stays in the corporation may be taxed under the accumulated earnings tax or the personal holding company rules, which we'll discuss later. When a shareholder does receive a distribution from the corporation, it's first taxed as a dividend at preferential rates to the extent that the corporation has earnings and profits, and any amount over the corporation's earnings and profits is taxed as a return to the shareholder's basis. If the distribution exceeds the shareholder's basis, any additional amount is treated as a capital gain. If the corporation distributes depreciated property, so property other than money, the corporation itself must recognize gain or loss attributable to that property rather than passing it on to the shareholders. And one way to negate the effect of double taxation is that the corporation can pay salaries and bonuses to its employees and shareholders who are also employees. And shareholders who are compensated employees will be required to pay tax on that income like they would income from any other source. But the compensation and the corporation's share of any payroll taxes are fully deductible by the corporation. So the corporation has no income to pay income tax on. All right, so the first example, AB Corporation has income of $100,000. So AB will owe tax at the corporate rate of 21% on its net income and will pay taxes of $21,000 on that income. Then if AB decides to distribute $50,000 of its income, that's all earnings and profits, that would be $25,000 to each shareholder. Since here our distribution is earnings and profits of the corporation entirely, it's taxed to each shareholder at a dividend rate of 20% for qualified dividends, but would also be subject to the 3.8% 3.8% net investment income tax on those dividend distributions. So the total rate of tax on that distribution would be 23.8%. So each A and B would pay $5,950 in taxes on the distribution on top of the $21,000 corporate income tax rate paid by the corporation. So this example, not all of the distribution is earnings and profits of the corporation. Again, AB is going to AB Corporation would still have that $21,000 corporate income tax that they would have to pay, but here we're just showing a difference in the distribution. AB is still distributing $50,000 of its income, $25,000 to each shareholder, but only $10,000 of that distribution is earnings and profits of the corporation. So that $10,000 worth of the distribution taxes dividends rates at 20% plus the 3.8% net investment income tax. And the remaining $10,000 of the distribution is treated as a return of basis to the shareholders, with any amount remaining over the basis treated as a capital gain to the shareholder. So A started with that $500 basis for contributing the machine, and then there's a $10,000 distribution, so $500 of that is return of basis, and the remaining $9,500 is going to be taxed at our 23.8%, which is the capital gains rate and net investment income tax, which results in $2,261 worth of tax. So A is going to pay a total of $4,641 on this distribution, which is $2,380 on the $10,000 that was treated as a dividend, $0 on the $500 that is treated as a return of basis, and $2,261 on the remaining $9,500 that is taxed as a capital gain to the shareholder. And then B, here we're changing B's basis down to 0 just for purposes of demonstrating a different effect. So there's no basis for B, to recover. So all of the $10,000 distribution is taxed as a capital gain, and the net investment income tax also applies. So it's taxed at 23.8%, which results in $2,380 in tax. So B pays a total tax of $4,760, which is, again, the $2,380 treated on the $10,000 that's treated as a dividend, plus the $2,380 that is treated as a capital gain to the shareholder. So this is going to show the effect of distributing all of the earnings as compensation. If AB has income of $100,000 again, but it's going to pay out 100% of its earnings as compensation. It doesn't owe corporate income tax since the corporation has no net income, but the income is taxed to the shareholders at their income tax rates, and payroll taxes may also apply. So if their wages are each $50,000, and assuming they're taxed at the highest individual rate of 37%, plus payroll taxes for Social Security and Medicare at a rate of 3.8%, their total tax rate is 40.8%. So each shareholder A and B would pay $20,400 in income taxes, but the corporation's not paying any income taxes here. So upon exit, shareholders generally recognize capital gains or losses upon the complete liquidation of a corporation. A shareholder may have to recognize a capital gain or loss or an ordinary gain or loss upon the sale of their interest in the corporation, depending on how long they held it. The corporation also has to recognize gain or loss upon liquidation for appreciated or depreciated property, and an individual or entity that buys a corporation's assets may be able to obtain a step up in the basis for the assets purchased. So in this example, again, we have AB Corporation that only has $75,000 of cash in the $500 machine, distributing half of that to each partner. So A gets $37,250 worth of cash, and A gets their machine, and B gets $37,750 worth of cash. But in this example, note that if the machine was depreciated and was only worth $200 now, the corporation itself would have to recognize a loss on the machine before distributing it to A. So upon exit, again, we're going to distribute $37,750 to each partner in liquidation, assuming A started with its $500 capital account for contributing the machine. Then there's the $37,750 distribution. The $37,250 of the distribution that exceeds the basis is going to be subject to tax as a gain from the sale or exchange of a capital asset. And assuming A is in the top bracket, they're going to owe $7,450 in taxes at the 20% rate. Then again, we're changing B's capital account to that $40,000. Then the $37,750 distribution, we're still going to have $2,250 in B's capital account after distribution. So B has a loss again that can be used to offset capital gains on their tax returns. Again, this is like the exit from partnership, except if AB Corporation had assets that decreased in value, the corporation itself may have to recognize a gain or loss rather than just passing that loss or gain out to the partners or shareholders. So S corporations are subject to a lot of the same rules as C corporations or partnerships, depending on how the corporation elects to be taxed. But this is the final entity structure we're going to discuss for comparison purposes. Generally, for formation, the same rules apply as C corporations under Section 351, but S corporations have strict limitations on the type of person that may hold an interest in the S corporation, the number of persons that may hold an interest in the capital structure. So that's kind of going to be the focus of what we're discussing here. Only one class of stock is allowed, but there may be different voting rights within that class of stock. Additionally, S corporations generally cannot have more than 100 shareholders, non-resident shareholders, or non-individual shareholders, which is subject to some exceptions. Generally, income is not taxed at the entity level, but is taxed to the shareholders under a pass-through regime That's based largely on the partnership model under subchapter K that we discussed earlier. Income, losses, deductions, and credits retain their corporate level character and are allocated to the S corporation shareholders on a per share, per day basis and are treated by shareholders as if attributable directly to the source from which they were generated. However, S corporations may be subject to tax on certain built-in gains that are attributable to prior periods if the corporation was previously a C corporation, and on any excess passive income, and some states like California also impose income taxes at the entity levels. Distributions of cash by S corporations that do not have accumulated earnings or profits are treated as a return of stock basis and then as a gain from the sale or exchange of property. S corporations that have accumulated earnings and profits are subject to a complex set of rules under Section 1368C that may cause some portion of a cash distribution to be treated as taxable as a dividend, and distributions of appreciated property, which are generally subject to the recognition of corporate level gain with corresponding increases in shareholder level basis. And then upon exit, an S corporation that distributes its assets in complete liquidation is subject to the general rules of Section 336 in the same manner as a C corporation. The corporation must recognize gain or loss upon a liquidating distribution of appreciated and depreciated property. So as a result, all gains and most losses with respect to various properties are triggered as a result of the distribution. However, unless Section 1374 applies, such gains or losses pass through to shareholders and in effect result in only a single level of tax. The sale or exchange of stock in an S corporation is generally taxed as a capital gain or loss, subject to certain exceptions though. Stock in an S corporation cannot qualify as qualified small business stock for purposes of potential benefits under Section 1202, which we're going to get into in the second half of this. And a buyer may be able to obtain the step-up and adjusted basis of an S corporation's assets, whether through an actual or deemed taxable asset sale or a possible stock sale coupled with an election. All right, so that was a lot of information. This chart kind of summarizes the different tax rates applied to each entity type with a few further categorizations. And also, we're just assuming the highest tax rate in each category. So for C corporations, if the corporation plans to distribute 100% of the earnings of the corporation as dividends, our 21% corporate tax rate applies, as well as the 20% individual income tax rate on dividends and the 3.8% net investment income tax. So the federal tax rate on that distribution is 44.8%. Then if the C corporation plans to hold the stock for at least 5 years and reinvest the proceeds in the business rather than making distributions, and you qualify under Section 1202, only this 21% corporate income tax rate applies. We're going to discuss Section 1202 in greater detail after this, but here the total combined federal tax rate is 21%. If the C corporation plans to pay out 100% of its earnings as compensation, or salaries, the corporation itself doesn't owe any income tax since it has zero taxable income, but the shareholders who receive compensation are taxed at their income tax rate, plus they owe payroll taxes like Social Security and Medicare tax, and this scenario results in a tax rate of 40.8%. And here, that 3.8% that's in the net investment income tax column actually represents the payroll taxes, not net investment income tax. So then the last three, if we have a pass-through entity, which is a partnership or an S corporation, and we are in one of those specified service trader businesses, which are the businesses that the principal asset of the trader business is the reputation or skill of one or more of its employees, and we have material participation by the owner. We do not get the QBI deduction since it is in a specified service trader business, so their tax rate is that normal 37% individual income tax rate, but the net investment income tax rate doesn't apply, so the total federal rate is the 37%. Then if we're in a pass-through entity and not a specified service trader business and have QBI, then the qualified business deduction applies, so that reduces our tax rate to the 29.6% rate after you have that 20% reduction for QBI, and then we have material participation by the owner, so there is no net investment income tax, and the combined federal rate is the 29.6% rate. And then finally, if we are not in a specified service trade or business, have qualified business income, but the owner does not materially participate in the business, we still have that lower tax rate of the 29.6 due to the qualified business income deduction, but the net investment income tax of 3.8% does apply, and the combined federal rate is 33.4%. So while a C corporation can benefit from the lower corporate income tax rate of 21%, the ultimate distribution of the earnings as a dividend or the sale of stock with an unadjusted basis at capital gains rates results in an increase in the effective tax rate to the owners of 44.8%, which exceeds the effective pass-through rate for an owner that materially participates in a business who gets that 29.6% rate. All right, so now I think it's a good time to pause and take some questions.
Great, thank you so much. That first session was very informative. I want to invite everyone to view their webinar controls and go ahead and take this time to type some questions into those controls. And again, I will read them out loud. And then Sterling will answer them. All right, while everyone is getting their questions typed in, I will go ahead and ask a question of mine that very specifically relates to our SC launch client companies. And a lot of our companies are formed just because an inventor comes up with something and starts a company to commercialize on their invention. A lot of times it's a one-man, one-woman company, a one-employee company. How does someone know what the right entity is to form if they are just trying to open up a company and they don't know exactly what their outcomes of that company will be?
Okay, so basically beginning stages of forming an entity, the two of the main concerns are going to be liability for that owner, whether they want to take on personal liability for anything that happens as a result of carrying on this business, and then also their tax effect of carrying on the business. So if they basically don't do anything and operate a business, they're going to be a sole proprietorship, which the sole proprietorship, you don't have to really have any formal legal entity classification, but you also are subject to liability for anything that happens. Say the product that's created causes a fire and that the person who lost their belongings or their home or anything decides to sue to recover their damages. Basically, anything that owner or that sole proprietor / inventor has can be used to pay for that lawsuit. And a lot of times people want to shield their liability and protect their assets that they've worked hard for. And so the partnership, C corporation or S corporation or an LLC helps to shield that liability effect. And then kind of the second point is taxes. If it's so a sole proprietorship would be one of these pass-through entities that are in the bottom three of this chart here. So all income passes through to that owner. So if they are, the tax effects kind of are more important later on down the road, not necessarily like when you're first starting out. So it's important for someone who's thinking about starting a business or who has a product and is trying to sell and market it to consult with someone who understands the tax effects of things. We're going to get into later some expensing benefits that are available to corporations for when they purchase assets or doing research and development type things. Some a potential way to defer or possibly eliminate a capital gain for using a C corporation, and just some other benefits that are available if an owner or a person who's thinking about starting a business thinks about these things and can plan ahead for them. But that's a long answer to your question. Mostly someone who's thinking about starting a business needs to think about the liability effects of the type of business that they start and the tax consequences for that business.
Good info. Thank you. That was a very complete answer. I appreciate it. Another question has come in, and it is an LLC treated as a partnership for tax purposes?
Yes. An LLC is going to be one of these pass-through entities. An LLC can elect to be treated as a C corporation, but most LLCs are treated as partnerships for tax purposes.
Great. Thank you. All right. So keep your questions coming. We will save them to the end. But for now, that is all the questions that we have on the table, and I will pass the mic back over to you, Sterling. Thank you.
All right. Thanks. Those were some great questions. All right. So now I'm sure you've heard a lot about the Tax Cuts and Jobs Act, and we are starting to see the effects of it since we are a little over a year out, and this is kind of given us some time to see how these changes actually impact things. But there were a lot of changes that were made to the tax system and the rate structure. One of the more important things when you're thinking about a C corporation is that C corporations no longer have a graduated rate structure. So for your personal income taxes, if you make a certain amount, you're in this tax bracket. If you make above a certain amount, you move up to the next or below, and vice versa. Well, C corporations all have one tax rate now. So some things we're going to discuss are asset expensing, and the interest deduction limitation, net operating loss limitations, benefits of and write-offs that are available specifically to C corporations, Section 1202, which we previously discussed, and which can help to defer at least a portion of a gain for C corporations when shareholders decide to exit, or it can potentially eliminate that entire gain so that the owner does not have to recognize that gain. And then we're also going to discuss briefly the accumulated earnings tax. So, as I mentioned, the Tax Cuts and Jobs Act made where all corporations are now taxed at 21% instead of that graduated rate, where the individual income tax rate is still a graduated rate up to a maximum of 37%. There is also no longer a corporate alternative minimum tax. And then we have this qualified business income deduction, such that the maximum rate is that 29.6%, which we previously discussed a little bit earlier. So non-corporate taxpayers receive a deduction equal to 20% of their qualified business income from a partnership, S corporation, sole proprietorship, estate, or trust, but not a C corporation. This results in an individual at the top marginal tax rate having a rate on their taxable portion of the qualified business income of 29.6% rather than that high as 37%, which we saw the effect of in some earlier examples. This does require that the business income be from a specified service trade or business, the business income must be not from a specified service trade or business, which are that laundry list of businesses in the fields of health, law, accounting, actuarial services, all those things where the trade or business kind of hinges on the reputation or skill of one or more of its employees. Also included in this definition of a specified service trade or business are businesses involved in investing or investment management, trading or dealing in securities or partnerships. But it's important to note engineers and architects were specifically exempted from this definition. in a definition we get into later, they will be included. Real estate can qualify as not a specified service trader business and therefore be able to take advantage of this QBI deduction, but we really need to make sure that the landowner does more than just accept a check each month. They need to be more involved. The deduction reduces the taxpayer's income by 20% of their qualified business income for each qualified trader business carried on by the taxpayer. And of course, like pretty much everything else in the Internal Revenue Code, there is a limit that is available to the deduction, and the deduction is limited to the greater of 50% of the taxpayer's share of W-2 wages that are paid to employees of the qualified trader business, or the sum of 25% of W-2 wages and 2.5% of investments in qualified property. But remember that the QBI deduction is not available for wage income or for business income that is earned through a C corporation, but this is set to expire after 2025. So we'll see if that gets expanded or if that the QBI deduction not being available anymore is something that also helps lean in favor of establishing a C corporation for tax purposes. Then the capital gains and carried interest. There is now a 3-year holding period requirement for gains from certain partnership interests to qualify for long-term capital gain treatment and therefore qualify for the maximum 20% rate. Usually to qualify for this long-term capital gain treatment, you only have to hold the asset for a year, but now you have to hold these certain partnership assets for 3 years. So if you have a gain that is recognized after 2017, regardless of when the taxpayer acquired the partnership interest, disqualified amounts are treated as short-term capital gains, which are subject to the ordinary income tax rate, which is the maximum rate of that 37%. And this restriction applies to partnership profit interests that are received in connection with performing services for a business that consists in whole or in part of raising or returning capital and either investing in specified assets or developing specified assets. Specified assets are securities, commodities, real estate held for rental or investment purposes, cash or cash equivalents, and derivatives that reference any of the foregoing. So this 3-year holding period requirement affects a lot of hedge funds, private equity funds, and real estate funds. And so if you're thinking about starting a partnership that's going to be a hedge fund or a private equity fund or a real estate fund, and you're thinking about getting out of it prior to 3 years from when you acquire the interest, then you may want to think about the effect that it's going to have for having to apply ordinary income tax rates rather than short-term or rather than long-term capital gain treatment. All right, asset expensing. The Tax Cuts and Jobs Act now allows taxpayers to take bonus depreciation deductions equal to 100% of the adjusted basis of qualified property that is acquired and placed in service between September 27th, 2017 and January 1st, 2023. So qualified property is defined as tangible property with a depreciation recovery period of 20 years or less. There are certain limited types of computer software that qualify for contributed property, which are the type that is generally available to the public and subject to non-exclusive licenses, and property that is used in qualified film, TV, and theatrical productions can also qualify as qualified property. But it does not include any property that is used in a real property trade or business or any intangibles. So property that's used for development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, or brokerage of real property cannot be fully deducted. This deduction does apply to new and used property, though. So this helps to kind of expense the entire cost of your property if it applies. So after January 1st, 2023, the deduction percentage is reduced annually from 100% for purchases of property until December 31st of 2026, at which point the deduction is not available anymore. So each year, 2023 through 2026, the amount that can be deducted is reduced annually. But this is really important for companies that make large capital investments in tangible property, and is obviously less valuable to technology or other companies that develop and invest in intellectual property or other intangible assets. Okay, the interest deduction limitation. The Act limits interest expense deductions for businesses other than small businesses. For this purpose, a small business is a business whose average annual gross receipts do not exceed $25 million. If your business does not receive $25 million in average annual gross receipts, this limitation does not apply. So most businesses, regardless of form, can deduct net business interest expense in any year up to 30% of their adjusted taxable income. For years beginning after December 31st, 2017, and before January 1st, 2022, adjusted taxable income is generally equivalent to earnings before interest, deductions, and taxes without regard to deductions allowable for depreciation or amortization. This is also called EBITDA. For taxable years beginning after 2022, adjusted taxable income is reduced by depreciation or amortization, so EBIT, and therefore allows for less of a deduction of business interest expenses. There are not currently any grandfathering provisions for existing debt, but disallowed deductions can be carried forward indefinitely. And the interest deduction limitation is important to more mature businesses above the $25 million threshold, but generally shouldn't affect startups and other pre-revenue stage enterprises. So this really affects if you take out a lot of debt and you have to pay interest on that, you can deduct that interest. And so this deals with how much of that interest can be deducted. All right, net operating loss limitations. Losses that were generated in 2018 or later are no longer allowed to be carried back for 2 years, but are instead allowed an unlimited carry forward period, replacing the former maximum of 20 years with some limited exceptions. So it used to be that you could carry back losses for 2 years and carry them forward for 20 years, but now we're just carrying forward indefinitely and no carryback period. So for losses that were generated in 2018 or later, not more than 80% of the taxpayer's current year taxable income can be offset by otherwise available NOL carry forwards, which means essentially you're going to be paying 20%, or at least 20% of your current year taxable income is going to be subject to tax. These provisions do not affect losses that were generated prior to 2018, so net operating loss carry forwards from pre-2018 years are more valuable than losses generated in 2018, since the losses that are generated in 2018 or later are subject to that 80% cap. One downside is that these rules require taxpayers to keep track of 2 different pools of NOL, so you have to keep track of your pre-2018 losses and your 2018 and later losses. And those 2 pools, you have to use the net operating losses on a first in, first out basis. So you have to use the oldest net operating losses first. All right, so some benefits of C corporations. C corporations have the ability to accumulate earnings for future expansion at a lower tax cost than most other types of entities. And they also have the ability to shift income for tax purposes easier. A C corporation can have a different tax year than the individual, whose tax year is a fiscal year. Therefore, the C corporation can make distributions or wait to make distributions until it's advantageous for the shareholders. This shifting of income can result in a lower overall income tax burden for the shareholders. Since the shareholders don't have to recognize the income of the business on their personal tax returns, they'll have a lower adjusted gross income, which may limit the phase out of various deductions and credits, including education and tax credits. But if the business owners take a salary, that amount is not taxed at the corporate rate, which shifts the tax equation even further in the shareholders' favor. And if you don't take a dividend, there's no distribution to be taxed at the double taxation level. There are also a few advantages for attracting future financing. So this also goes to the question that was asked earlier about when you're starting a business, some things you should think about. If you want to attract future financing, a C corporation encourages that a lot easier than other entity structures. So there's fewer ownership restrictions for C corporations. S corporations have a lot of rules that limit ownership. You can't have non-individual owners, which now they have made it where you can have some trusts that are eligible to be owners in S corporations, but there is still that limit unless you fall in one of those exceptions. You can't have non-resident alien owners, so you can't have foreign owners. You're limited to 100 owners, so that limits your attracting of future financing just based on the number of owners that you can have. And investors don't really want their hands tied in an S corporation. C corporations provide a lot more flexibility than other entity structures. And C corporations also encourage passive investors. A partnership's advantage of passing losses through to individuals only applies to partners who actively participate in the management of the partnership. And passive investors tend to fare better tax-wise under C corporations. Then finally, C corporations make attracting financing and going public easier. Venture capitalists prefer flexibility of a C corporation's ownership structure, and if you want your business to grow so much that you foresee it being sold on a national stock exchange, only C corporations are eligible to be sold on, for their stock to be sold on a national stock exchange. Then some tax write-offs that are available to C corporations. You can carry your profits and losses forwards and backwards. Again, C corporations can pick a date other than a calendar year for their fiscal year. So shareholders can shift income easier, decide what year to pay taxes on bonuses, and when to take losses, which can result in a significantly lower tax bill. Shareholders can shift income readily and retain earnings within the company for future growth at a lower cost, usually, than pass-through entities. S corporation profits appear, and S corporation and partnership profits appear on a shareholder's tax return, regardless of whether they have taken a distribution or not. So owners can get pushed into a higher tax bracket even when they put all of their profits back into the company. C corporations have the ability to write off salaries and bonuses. So shareholders can also be salaried employees. Salaries and bonuses are subject to payroll tax, Social Security tax, and Medicare contributions, but the corporation can fully deduct its share of payroll taxes. Employees can be paid enough that there are not taxable profits left at the end of the fiscal year. Within reason, of course, the IRS does check salaries corresponding to services that are provided by shareholders as employees, but this does provide an option for distributions to shareholders that are not taxed twice. A C-Corp can also deduct medical premiums and other fringe benefits if the fringe benefits are available to all employees, not just shareholders. Tax write-offs are available for the C corporation. So the C corporation gets a tax write-off, and the individuals receive tax-free medical reimbursement plans, as well as premiums for health, long-term care, and disability insurance. Where for a partnership or an S corporation, these deductions would be a wash. The shareholders deduct the medical costs from their gross income, but they have to declare them as fringe benefits. And then also, finally, C corporations can write off charitable contributions. They're the only corporate entity that can deduct contributions as a business expense, up to a certain limit, of course, but anything that they cannot deduct is carried forward over the next 5 years. All right, so Section 1202, qualified small business stock. This is what I was mentioning earlier, that allows a taxpayer to exclude the gain from the sale or exchange of qualified small business stock if it's held for more than 5 years. And this section is very advantageous for taxpayers who invest in small businesses. So we're going to delve further into some requirements. But generally, the exemption is available to non-corporate holders of qualified small business stock. This exclusion is only available for stock of C corporations. Gains from interest in any other entity structure do not qualify. So you have to have stock of a C corporation that is owned by non-corporate owners, which is individuals or any partnerships, LLCs, any of those other entities, but the stock has to be owned in a C corporation. And so for this to actually work, the business owner has to plan from the beginning to use the sale of stock as an exit strategy. All right, so taxpayers who qualify can potentially exclude up to 100% of a substantial portion of the gain realized from the sale or exchange of qualified small business stock that is held for more than 5 years. The amount of the gain excludable from income depends on when the qualified small business stock was originally issued. If the stock was issued before February 18th, 2009, the exclusion is limited to 50% of the gain. If the stock was issued between February 18th, 2009 and September 27th, 2010, up to 75% of the gain can be excluded. And if the stock was issued after September 27th, 2010, up to 100% of the total gain for all qualified small business stock may be excluded. There is a limit to the amount of gain that can be excluded. It's up on this. It's the limit on this slide. It's limited to the greater of $10 million or 10 times the aggregate adjusted basis of qualified small business stock issued by the corporation and disposed of by the taxpayer during the taxable year. So since this applies to the higher amount of the two measurements, the total gain excluded can be more than $10 million. A corporation that qualifies to have qualified small business stock can have up to $50 million in assets upon its inception. So the maximum amount of gain excludable or eligible for the exclusion could reach $500 million under the 10 times basis rule. In the interest of time, I'm going to skip through some of these things, this slide, but it just takes a closer look at some of the statutory requirements to qualify. This slide it lists the primary requirements for Section 1202. The stock must be issued by a qualified small business and generally must be acquired by the taxpayer at original issuance. A qualified small business is a domestic corporation that is a C corporation, and the aggregate gross assets of the corporation cannot exceed $50 million at all times before the issuance and on or after the date of enactment of the Revenue Reconciliation Act of 1993, and the aggregate gross assets of the corporation immediately after issuance do not exceed $50 million. So this is where we get that 10 times basis limit that actually gets up to $500 million. And the corporation must also use at least 80% of its assets in the active conduct of a qualified trade or business. Then you also must have a qualified trade or business. This is very similar to the qualified business income deduction that we were discussing earlier, that it's the trade or business that involves the performance of services in the fields of health, law. This is the one that actually includes engineering and architecture, accounting services, actuarial services, performing arts, consulting, athletics, financial services, brokerage services, and trade or business, where the principal asset of the trade or business is the reputation or skill of one or more of its employees. These businesses do not qualify for Section 1202 benefits. So you want to have a company other than a qualified trade or business. Or sorry, you want to have a qualified trade or business, which is defined as a business other than those businesses where the principal asset of the business is the reputation or skill of one or more employees. That whether a business is a qualified trade or business is a very fact-specific inquiry. So you really want to make sure that if you're going to rely on this 1202, that it's your business is gonna qualify. And then there's also a 5-year holding period requirement. Sorry, I went too far. That the taxpayer has to hold the stock for more than 5 years to be able to exclude any gain recognized from the sale or exchange of the stock. Generally, it starts the date on the date of issuance of the stock, but tacking rules may apply if the stock is converted or transferred by death or gift. This is basis rules. I'm skipping through some of this because I just do want to mention the accumulated earnings tax. The accumulated earnings tax is a tax that can be imposed on C corporations, and the purpose of this tax is to prevent a corporation from holding on to all of its income instead of making distributions to shareholders. It is essentially a 20% tax on the income, the accumulated taxable income of the corporation. And in order for that 20% tax to be imposed, there must be a purpose of avoiding income tax, and the company must permit the earnings and profits to accumulate rather than dividing or distributing them. We haven't really seen the IRS be too picky on this accumulated earnings tax, but you just want to make sure that the corporation is not hoarding a lot of money inside the corporation and not making distributions, but is using the money for things like making loans to shareholders or things that are not related to their business. So skipping through some of these. Okay, we're going to end with this. Basically, a C corporation has the widest range of deductions and expenses that are allowed by the IRS, especially in the employee fringe benefits area. So if you do structure the entity as a C corporation, some tips to avoid double taxation. You can structure the C corporation so there's no profits left over. Use all the write-offs and deductions that are allowed by the IRS to reduce the net income. Offer great benefit plans, and have the corporation pay higher salaries to shareholder employees than it would using a flow-through entity such as an S corporation or a partnership. The shareholders will have to pay their payroll taxes and personal income taxes on those distributions, but they avoid paying taxes on dividends that are distributed by them as a second level of tax. So I'm going to finish with this slide back up here, and I'm happy to answer any questions here, or I am always available by email or by phone if anybody has any further questions or comments that they would like to discuss.
Thank you, Sterling. I appreciate it. In the interest of time, I'm going to jump right into the questions. A question has come in. It says, at what point would you advise a company to move from an LLC to a C-Corp? For example, is it when they want to raise money? Is it when they take in, more employees? Like, what is the sort of pivotal point that you would recommend that shift?
I don't think that there is just, a one-size-fits-all answer to this question. I think that you got to look at all the facts and circumstances. If it makes sense for purposes of raising capital, then, that may be a reason to change. If it makes sense for you're thinking about going public, that's a reason it would make sense. But sadly, that is a very facts and circumstances question and answer that would need to be provided. So I can't provide really without knowing more if it would make sense to convert to a C corporation. But if you'd like to reach out to me, and I'm happy to discuss it further.
Great, thank you. I want to respect the time and just say thank you so much to everybody for joining in. Thank you so much to Sterling for hosting this webinar. Really informative, especially in our line of work where, that last question is one that we hear a lot. It's like, oh, you're not a C Corp, you're raising money, should you be, et cetera, et cetera. This is just such a hot topic right now. So I appreciate you going over it in such great detail. So I just want to sign off and say thank you to everyone. We have another webinar coming up on hot topics in patent law on the 25th of May. If you are not registered and have interest, please reach out to me directly at julia.linton@scra.org. Thank you again to Sterling, and thank you to everybody for joining us. Say goodbye.
Thank you.
Thank you so much. Bye-bye.